Hi class, wanted to go over problem 1-8, and this is just giving you some more demonstration on how to utilize the accounting equation assets is equal to liabilities plus equity and creating journal entries or categorizing various transactions. So I think I'm gonna try to do this in two segments because I think 15 minutes is basically all I have, and I don't want to do too much and talk too fast, so I want to take my time. So if you go into your textbook on page 40, exercise or problem number, actually it's going to be on page 39, which is problem 1-8A. We're going to go over a couple of different couple transactions. I will try to go through every single one of them and work on the financial statements, but let's just see how long 15 minutes will take us. One of the things you have to do is when you're looking at the transactions, you want to find out what are the two or three accounts that are affected. On the asset side, you want to find out what accounts are being affected, and you want to find out on the liabilities and equity side what accounts are being affected. The second step is to determine is it an increase or a decrease and how it shows on that accounting equation. So, for example, December 1st, Helga Ander transferred $65,000 from her cash savings account personal savings account to her checking account in the name of Ander Electric. So we want to take those transactions, that's one transaction, and we want to record it. So let's do that. So money is going into our cash account. So it's going to be a positive. And we're going to go into her capital account because she is going to be making an investment and she's putting it into her capital account. She's basically established her firm with $65,000 of her personal savings, and it's going into her checking account. On December 2nd, the company rented office space and paid $1,000 for December rent. Two things we need to know: what's decreasing and what's increasing. Well, in this transaction, what's decreasing is cash, and cash is decreasing by $1,000. What's increasing is she's paying an expenditure for rent. So on the equity side, she is going to show a transaction for expenses. As we talked about before, expenses are reductions in equity, revenues are increases in equity. So we're going to put a reduction in equity of $1,000. And as you can see, for both of these transactions, everything equals on both sides of the equal sign. The assets is equal to liabilities and equity. So let's go to December 3rd. The company purchased $13,000 of electrical equipment by paying $4,800 in cash and paying $8,200 in 30 days. So they're going to make a promise to pay. So we've got three transactions that we have to, or three different accounts that we're going to have to affect here. First is the $13,000 for the equipment. So we're going to put that in first. Now, something's decreasing. It looks like we're going to pay cash. So cash is going down. We're going to decrease our cash by the amount that we're paying right now, which is going to be $4,800. And what's next? Because now we've got an entry that's out of balance. We've got, what's the rest of the entry? Well, the rest of the entry is the $8,200 is going to be paid in 30 days. So we have a liability, accounts payable liability, very, very short term. So we're going to go to accounts payable, and we're going to put in there an increase of $8,200. So we're increasing our liability. So now we still have a balanced equation. We have a decrease in our cash of $4,800. We have an increase of equipment. That nets out to be $8,200. On the opposite side of the equal sign, we have a liability that's increasing of $8,200. So we have a balanced entry. On December 5th, we want to do the same thing. The company purchased supplies and they paid by cash. So they purchased $800 in supplies. So cash is going to go down because we're going to pay $800 and we're going to increase our supplies. One thing to note, not all transactions are going to affect both sides of the equal sign, meaning assets may very well be the only side of this equation that's affected. So what we're doing here in this case is we're shifting from one cash account or one asset account to another, in this case office supplies. And again, the accounting equation still works. So we are moving money from one asset to another, and the transaction is complete. The next transaction on the 6th of December, the company completed electrical work and immediately collected $1,200 for these services. So this company is going to collect money, revenues for services performed, and they collected it in cash. So it looks to me that cash is being received, so we got an increase in cash. And okay. So the next is $1,200 we are receiving. Now, we're getting $1,200 for services rendered. That tells me that we're increasing our equity and we're increasing our revenues by $1,200. Now we have an equal accounting equation. We increase our assets, in this case cash, by $1,200, and we are increasing revenues, which is increasing our equity, by $1,200. Now, December the 8th, we purchased $2,530 of equipment on credit. So we didn't pay cash, so cash is not affected. We're going to deal right now with the asset, and that's going to be office equipment. So we'll go to office equipment for $2,530. Now, we didn't pay cash for it, so how did we actually pay for this? Well, it looks to me we're going to have it on credit, so we got to eventually pay this back. So we're going to increase our accounts payable. On December the 15th, we completed our work, services were rendered, but we didn't get the money in cash. Completed electrical work on credit in an amount of $5,000. So right now, cash is not affected, but we're going to expect that money in the future. So we're going to put accounts receivable as an increase in our assets, and we're going to increase equity in our revenues of $5,000. On the 18th, we purchased $350 of office supplies on credit. So again, cash is not affected, but we're going to affect our asset of office supplies, and we're going to decrease our expenses. We're going to actually office supplies. We want to hit office supplies, and we're going to hit accounts payable, excuse me, because we have not paid this yet. We're going to increase our liability. On the 20th, we paid our cash. We actually paid off that accounts payable bill in a form of cash, so we're going to reduce cash by $2,530, and we no longer have a liability on our books because we paid off that bill. So we're going to reduce our liability by $2,530. On the 24th, we billed our client for $900 for electrical work due in 30 days. So we did our work, but we haven't gotten the cash for it, so we're going to expect money in 30 days, so we're going to hit accounts receivable. And we perform services, so we're going to hit our revenues. Next, we're going to receive cash for work completed. So we're going to increase our cash by $5,000, and we're going to remove that receivable that we had on our books, which happened on the 15th, and we have a balanced entry. Next, on the 29th, we paid our staff in cash $1,400, and we want to reduce our equity by recording a $1,400 credit in our expenses. The 30th, we are going to pay $540 for our utility bill. So cash is going down again, And we're going to decrease equity by recording an expense, $540. On the 31st, which is our last transaction, and we're going to close right here, and that is we withdrew $950 for personal use. So I'm going to take this $950 out of our checking account, and I am going to offset the partner or company owner withdrawal, which is going to be $950. This is one part of a 2 or 3-part problem. I'm going to stop here. This shows all the transactions that we recorded for the month of December, making certain that we follow the guidelines of our assets equal to liabilities and equity. I will continue this transaction with preparing a trial balance and a financial statement. I'll talk to you later, and I hope this helps you.